Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the bullish scenario on the weekly time frame, where we're looking for a bigger 5-wave impulsive structure to the upside, and inside wave 3 we have a lower degree 1, 2, 3, 4, 5 in green, possibly 4 finished inside the common target area for your wave 4, the 382 to the 05, 57.5k to 53.3k, taken from the low to the high of 3, with the invalidation of this scenario being the 618 at 49.3k. We also here found some additional support to make that potential low of wave 4 and move up in a wave 5, which is the channel taken from the low to 24k to the first time touching 30k. You can see it is very nicely respected, price grinding on the midline here, moving to the upside, the midline upside once again, breaking out with a little order block and now retesting, where of course in this scenario you're looking for continuation, because if you do find respect back inside this channel, the probabilities increase to move to the midline and look for a bigger retracement towards the downside. On the 4-hour time frame, your first bullish scenario is an impulse to the upside in a wave 1, 2, 3, 4, 5. Here, your wave 4 is possibly finished once again in the common target area for your wave 4, the 382 to the 05 fib, taken from the low to the high of wave 3, giving you an area between 67.5k and 66k. The invalidation for this scenario is price moving to the downside and touching the high of this wave 1, because in an impulse, wave 1 and wave 4 are not allowed to overlap. What has to be said is that this wave 3 though is quite short for an impulse to the upside. Most commonly, your wave 3 is the longest, strongest, most impulsive and extended wave in an impulsive structure 1, 2, 3, 4, 5, where the 1.618 is usually a minimum target. So because wave 3 is relatively short, it does open the door for a double 1, 2, which is a more bullish scenario, where you have a bigger 1, 2, 3, 4, 5 in green, and then inside the green wave 3 you have the sub-degree count 1, 2, 3, 4, 5, meaning wave 3 hasn't started yet. You're still looking for a big breakout, a big high volume wave 3 to the upside to reach much higher targets. Now in this particular scenario, the most common target area for your wave 2 is the 05 to the 786 Fibonacci, taken from the low to the high of your blue wave 1, giving you an area between 66k and 62.6k. The 382 is uncommon, 67.4k, and the 886 is rare at 61.5k. As you can see, the low over here has been made just above the most common target area for your wave 2, and it is no problem for this wave 2 to become a bigger corrective structure, after which we then expect continuation to the upside. The only thing that then lowers the probabilities is that this wave 2 is going to be bigger in time and price compared to your higher degree wave 2, looking at the vertical line on the chart, which is a fib time taken from the start to the end of green 2 to the end of the blue wave 1, comparing the two wave 2s in time, and preferably your lower degree wave 2 in blue is a little bit shorter in time and price compared to your higher degree wave 2, so possibly this is therefore the low of your wave 2, but at least the opportunity is there that if you do take out the previous bullish scenario by reaching invalidation, the next highest probability scenario is going to be that double 1, 2. We also had some additional support where price bounced here at the moment, which was the point of control of this range. Price has been in this sideways range for a very long time, and you can see we re-entered the range, moved to the point of control, value area high, then came back in and found support at the point of control. Losing the point of control, and probabilities do increase to move to the other side of the range, which is the value area high at 62.3k. If, however, this is your low and we are looking for price to move towards the upside, then we want to count an impulsive structure on the lower time frame, where we have a wave 1, 2, 3, looking for 4, and at least one more high in a wave 5, with inside this wave 3 a 1, 2, 3, 4, a 5-wave structure. Don't look at this wick, this is a scam wick. On many other charts this wick is not there. Wave 4 common target is the 0.236 to the 382 in this case, because the invalidation here is avoiding you the opportunity to move towards the 0.5. The 0.236 is at 68.9k, the 382 at 68.4k, taken from the low of 2 to the high of wave 3, and the invalidation for this impulsive scenario is 68.2k, which is the high of your wave 1, because in an impulse, again, we don't want to see overlap between a wave 1 and a wave 4. The alternative bullish scenario on the weekly time frame is that your wave 4 is not yet finished and you continue this range for a little bit longer. Here we have a wave 1, 2, 3, 4, and then a wave of 5. So one more push to the upside, finishing wave 5, and then get a bear market once again. Common target for your wave 4 is the 236 to the 05, taken from the low of 2 to the high of 3, giving you a target between 62.3k and 49.3k, with the invalidation being the 0.618 at 43.5k. Preferably, this range over here is not yet finished for this wave 4, as most commonly a wave 4 is longer in time than wave 2, so the vertical lines on the chart, preferably a wave 4 ends after the 1-to-1, which is the 12th of August, FIB times taken from the start to the end of 2 to the end of 3. But as you can see, the low here has been made before the 0.382 FIB time, which would be a minimum target for a wave 4, because the rule of alternation does say that if wave 2 is long in time, wave 4 has a higher probability of being short in time, but at least ending after the 0.382 would be something we like to see. So therefore, we prefer to see a continuation of this range on the lower time frame, and therefore on the daily time frame, we're looking for a zigzag A, B, C, 535 with a leading diagonal in a wave A, 3-wave corrective structure in a wave B, touching the 886, common for a wave B, and then a wave C to the downside, 1, 2, 3, 4, a 5-wave structure, preferably ending below wave A over here at 56k. Now inside this structure to the downside, we then need to look for bearish impulsive structures, and there's only 3 bearish impulsive structures in this case: a normal impulse to the downside, a double 1-2, 1-2-1-2, and a big 3, or a diagonal. And at the moment, the only option that you have left here is a diagonal, but this then becomes an expanding diagonal, and an expanding diagonal is very rare, never preferred, unless all of the other stuff fills. Nonetheless, what we are looking for here then is a 3-wave structure in a wave 1, in a wave 2, in a wave 3, looking for a 3-wave structure in a wave 4, preferably that's your end, and then a wave of 5 towards the downside. The 0.5 for wave 2 is uncommon in an expanding diagonal, as a wave 2 and a wave 4 usually retrace to at least the golden pocket 786 or even the 886. The 1.272 and the 1.38 is however a common target for your wave 3, taken from the start to the end of 1 to the end of wave 2, and the common target for your wave 4 is the golden pocket to the 886, taken from the start to the end of your wave 3, giving you a target area between 68.9k and 70.2k. As explained, inside that wave 4, we are then looking for a 3-wave structure to the upside, which preferably is finished at the current high that we have, and that is because of time. Here we then have a wave A, wave B, and a wave C, counting in wave C a 1, 2, 3, 4, and a wave of 5. However, if price moves to the upside and takes out this high, it means that this structure here has to become your wide wave 4, and that has low probabilities because of time. Look at your wave 2 here, which is very short compared to then the wave 4 that you have, which is incredibly long, lowers the probabilities that if price takes out this high, you're looking at a 3-wave structure, increases the probabilities you're looking for a 5-wave impulsive structure. We also have some CVD divergences, still the same ones as yesterday, bullish CVD divergences. First we had it over here, higher low in price, lower low on the CVD, but with the new low over here, lower low on price, we still have the same divergence, higher low in price, lower low on the CVD, which can be seen over here on the chart. So we had higher low in price, lower low on the CVD. That was the first time. Price continued ranging, moved down once again, creating a new local low here, but still higher low in price, lower low on the CVD, and as it stands, no bearish CVD divergences on the chart. Lower high on price, but also lower low on the CVD. So if we then go to the probabilities of the different scenarios, then on the weekly time frame, the probabilities are higher for the the bullish scenarios compared to the bearish scenarios. On the 4-hour time frame, the probabilities are higher for the impulse or the double 1-2 compared to a zigzag to the downside on the daily, starting with an expanding diagonal. And on the 15-minute time frame, the probabilities will remain higher for an impulsive structure unless price hits the invalidation at 68.2k to accept an ABC to the upside. If, however, price moves to the upside and takes out the high, then we're going to be increasing probabilities for an impulse on the 15-minute. Reasoning is that expanding diagonals are very rare, never preferred unless all of the other stuff fails, and the move down from 72k counts best here as a WXY double zigzag. Zigzag in a W, correction in X, and another zigzag in a wave of Y, which therefore is bullish, or you have an expanding diagonal as another option in a 1, 2, 3, 4, 5, but a WXY has a higher probability compared to an expanding diagonal. Therefore, the probabilities are higher to continue to the upside. I hope that this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.